Hi, good evening, everyone. Welcome to this webinar session on China. So today, joining us at this session are Zico Xiao, who is our research analyst from our IFAS China research team, and Lisa Lim, Associate Director of Intermediary Business from First Center Investors. So in this session, they will share their views on the recent market volatility in China and where to find pockets of opportunities that still exist in the Greater China region. So without further ado, let us welcome our first speaker, Zico.
Thank you. Hello everyone. I'm Zico from FSSA China research team, and today I'm gonna share a topic which is China's investment outlook for the second half of the 2021. I divided my topic into two parts. So for the first part, I'm gonna give an explanation for recent slump in China equity markets from a bigger picture. So, as we all know, since previous United States President Trump signed tariffs memorandum against China in March 2018, imposing tariffs on up to 60 billion US dollars of imports from China, the trade war between China and the United States have officially begun. After that, the United States dragged China into more battlefields that were beneficial to US, including technology and financial wars, and various laws and regulations have been enacted, such as FIRMA and ERICA, and the voice of decoupling between China and the United States have become louder and louder. So based on such a serious situation, China first proposed a dual circulation in economic strategy based in internal circulation on May last year. Industry upgrade and consumption release are the core of internal circulation. So what is consumption release? Consumption release is to address two obstacles and to ease burden that previously hindered residents' consumption. The two obstacles are poverty and housing. So housing are for living rather than speculation was mentioned to tackle the first obstacle. So starting from July last year, a series of housing-related policy has been promulgated, including the most strict purchase restriction against housing, cancellation of school district houses, and teaching rotation system. It undoubtedly shows that the history mission of the houses as an investment product has basically ended up. The urban restructuring is to solve the problem of poverty. So according to the results of the 7th census, there are currently 600 million people in China with a monthly disposable income of less than 1,000 yuan. Increasing the income of these people contributes greatly to consumption. So those people will consume almost all of newly added income. However, for people who earn more than 10,000 yuan a month, the newly added money will be used almost for investment. Therefore, due to diminishingly marginal utility, it is better to increase the income of the poor. So where are those people from? So most of these 6 million people are distributed in the inland areas. Therefore, since 2020, there have been more and more specific policies aiming at the central and western cities. From a higher perspective, the pattern of trade is also changing. Once the goal of the Belt and the Road Initiative and the reset achieved, China will open up new markets. Obviously, it is an unprecedented benefit to Midwest cities like Xi'an, Chongqing, Chengdu, Kunming, etc. So the finally centralized procurement to healthcare, double reduction to education, and increased residents' pension to aging. It can be seen that the pattern of this industry is ongoing tremendous changes. By implementing specific policies, China made steps one by one to reach its objective and to respond to the changes of the time. So in this slide, we can see in the past 30 years, China's government was fighting against the absolute poverty. Therefore, such strategy as efficiency priority and economic development coming before governance were prevalent in the past. The results are still significant. We can see from the first chart, the poverty rate kept falling down to less than 1% by 2020, and per capita disposable income reached over 30,000 yuan at the end of the last year. However, at the same time, with the wealth creation campaign with some people, the gap between rich and poor are getting widening. In 2020, the proportion of residents in the top 1% of China's wealth ranking in total wealth raised up from 29% to 30.6% in 2020. In 2020, China has a total of 5.279 million millionaires, ranking second in the world, increased by 5.1% from last year. So now we are at a significant moment in the history of China's economy and capital markets. So after a decade-long journey to eliminate absolute poverty, Beijing is shifting governance priority from growth to balancing growth and sustainability, social equality, data security, and self-efficiency. And you can see there are 4 risks that we should be aware of, which are social risks, national security risks, and financial risks and environmental risks. Taking these factors as a guide, we can see clearly the new economic trend. It is to reduce the profit and monopoly of real estate, finance, education, internet, etc., which squeeze the cost of people's livelihood and the real economy in the long term, and to develop manufacturing, hard technology, real economy, new energy, new infrastructure, capital markets. All of this will help us to invest in China, not only for now, but also for the future. So above all, there are 2 reasons behind the recent slump in China equity. First of all is the slowdown in economic growth. We can see the China's capital markets has performed pretty well, started from 2019, and it mainly benefit from the effective control of the epidemic and the rapid economic recovery. So the accumulated rise of the stock market needs for adjustment. And the second reason is that the recent regulations about the specific industries. Okay, so my second part is to give a investment outlook for the second half of the China's market. But first of all, I'm gonna talk about the macro economy. So from the perspective of economic fundamentals, 2021 is the first year of the entire economic construction and the first year of the 14th five-year plan for national economic and social development. So looking at the first half of the year, the economic data was very eye-catching. In the first quarter, GDP reached a record high of 18.3%, and export and investment had clearly returned to pre-epidemic levels. But we still can see the 2-year compound growth rate of the consumption was lower than market expectation. From the another perspective, as you can see from the second chart, so the data of the three major departments, which are the first and the second industries representing agriculture and infrastructure, have returned to the level before the epidemic. But the territories industry, which representing the service industry, was still a relatively weak performance. The main reason is that during Chinese New Year, the local celebrating New Year policy has a strong restraint on consumption. During the epidemic, the growth rate of residents' income fell down, but residents' savings have also increased significantly. In the future, consumption will continue to grow at a higher rate due to effective control of the epidemic and opening of the country, and also the recovery of tourism. So with reference to United States, when the per capita disposal income exceed $5,000, people's consumption habits will change from the pursuit of quantity to the pursuit of quality. When the per capita GDP of the entire society exceeds 10,000 US dollars, the driving force of economic growth transfer from investment to consumption. By the end of 2018, the per capita GDP has exceed 10,000 US dollars, taking China urbanization rate of 1% per year. The annual increase of 13 million people will have an important impact on future consumption. So the PMI has maintained a level above the critical line for 5 consecutive months, indicating that China has basically maintained a strong momentum in industrial activities. In terms of exports, the first half of last year was mainly based on the transformation of low profit materials to housing culture. From the perspective of the whole year, so although there will be certain pressure on the transfer of orders in China after epidemic resumed, considering of China's important industrial chain in the world, export will still be more transferred to a direction related to household and travel. So policy in this year will still focus on direction of preventing financial risks and controlling leverage. From the results, there is no misalignment between M2 and economic growth. From the perspective of the leverage ratio of the macro and the physical sectors, it has basically maintained a steady downward trend. We believe that fiscal policy will be the main force in the second half of the year, especially through the accelerated issuance of specific bonds. It can ensure that some investments related to people's livelihood can be actively implemented. Okay, so, and apart from the fiscal policy, we see the monetary policy will remain at a relative level. The increase of overall global demand has resulted in a relatively substantial increase in the price of the commodities. For example, the crude oil price grew 40% year to date due to China's lack of mineral pricing power and the scarcity of natural resources. The rise of overseas commodity will inevitably lead to a trend of domestic PPI. Therefore, we can see there has been a clear uptrend in PPI in this year, reaching 9% by May 2021. Okay. So the above is a picture of the overall macro fundamentals. And from the overall macro perspective, stock market investment still relatively optimistic. So my next part is to talk about the China's equity market. So as you can see, the red line represents the valuation level of the wind A-share market, excluding financial and petroleum. If you look at the timeline, every time you invest in a dimension that is less than one standard deviation, you will get a relatively rich return. Currently, the overall valuation level has raised up comparing to 2018, but is still below the fair value line, representing there will still be room for upward movement in the future. So when we take a look into different sectors, we still maintain our view at the beginning of the year, and we are optimistic about the three major sectors of which are financial materials and consumer discretionary. So we only made a little change of energy and the industry, mainly considering that the rise in the commodities will squeeze the profitability of downstream industries. And for this slide, here is the rationale behind the why we choose financial materials and consumer discretionary as a positive sectors. So for financials, we divided financials into banking and non-banking financial institutions. For the first one, the growth momentum is still resilient, and the net interest margin is expected to stabilize in the second half of the year, creating more potential earnings for banking industry. And for non-banking financial institutions, internal structure is expected to optimize in the 2 years to 3 years. Leading institutions will improve their business model and operation efficiencies. And the industry is perspective to enter next stage. This sector is worth allocating under extreme market conditions as it can provide a safety cushion to reduce volatility. For the second sector, which is materials, so when we see from the earnings in this sector, the sectors such as non-ferrous metals and the chemicals will obviously benefit from the rise in global commodity prices, and it's expected the annual corporate earnings growth rate will remain at a relatively high level. For the last one, which is consumer discretionary sector, so we divided it into three main dimensions, which are white goods, automobiles, and duty-free stores. So for the first one, the housing sold accelerate in the first half of the year, expecting to bring more needs for white goods in the second half of the year. So for the second one, due to the shortage in chips, may impact 5% of the production capacity. The automobile sales may also be affected, and the demand is expected to gradually release in the following 2 years. And for the last one, which is duty-free stores, thanks to the new taxation policy on duty-free stores announced last July, the offshore duty-free sales create new highs. The passenger flow increased at major domestic airports, and the high-cost duty-free plaza has opened, supporting the China duty-free to generate more revenue in the next 3 years. So before I end up my presentation, there are 5 conclusions for the 2021 Mainland China investment outlook. You can take a look. So we still have our attitude for the annual GDP growth rate remaining at the 8.5% for the whole year, and consumer sectors will improve and the investment will stabilize. RMB appreciation comes to an end. And for CPI and the PPI, we think that they will gonna be behave better in the second half of the year, and the annual inflation will be controllable. And for monetary policy, it will be stable, and the fiscal policy will be used to help small and medium-sized enterprises to overcome difficulties. And for stock market, we think the A-share opportunities will mainly depend on the stock's earning growth rate. And for asset allocation, we think we should focus on overweighting equities rather than bonds, and sector balanced application is preferred. Okay, so that will be all my presentation today. Thank you.
All right, thank you, Zico. We'll now move on to our next session. Our next presentation this session with Lisa Lim from First Sentier Investors.
Hi, everyone. Thank you. Let me just pull up my presentation deck. So thank you so much, Zico, and it's my great honor to be here today to speak to all of you physically, virtually. And obviously, the hope is that we have the opportunity to meet up face to face. Many of our clients have stayed invested with us over many years, and through the days of us being known as First State Investments till today, First Sentier Investors. And we truly thank you for your support that you have given us. No way do we take that for granted. So we wanted to assure you that while we have changes in our brand name, our distinctive investment approach and the way that we manage our clients' monies have not. Whether these are in-house or individually branded teams, we all want to highlight that the strategy that I'm sharing today is managed by FSSA investment managers. I think this is a team that some of you might be familiar with. And in the next couple of slides, I'll just quickly introduce the team and their investment process before I talk about our view on China markets. Okay, so the FSSA investment managers is an investment specialist team. They have specialists in APAC as well as emerging market strategies. This investment team manages 38 billion on behalf of clients across the wholesale as well as institutional investors. They also operate as an autonomous investment team within First Sentier Investors, and they are based across 3 different locations: Hong Kong, Singapore, and Edinburgh. So this is a quick snapshot of our investment strategies, which we would cover, ranging from regional single country portfolios across the universe of small, mid, and large cap stocks. So today on Regional China Fund, this is a strategy that covers China, Hong Kong, and Taiwan. Obviously, China does provide a very large opportunity set in the region, and hence most of our discussions will be around China markets. But Taiwan, together with its tech sector, which is really large, you also have Hong Kong, which is a lot more developed in terms of governance and regulatory framework. All of these offer a number of interesting investment opportunities, which we all build up on a bottom-up basis. Okay. FSSA Regional China is managed by managing partner Martin Lau. He has performed respectably in terms of his fund performance over various time periods, and I would also have a snapshot of that later on in the performance charts to share with you. I think a little bit more about this investment team will be good for everybody to understand a little bit more background on them. Everyone on this investment team is an analyst first and foremost. Portfolio management is an additional responsibility that some of these team members have. So ultimately, the portfolio manager decides what goes into the portfolio. It doesn't work on a consensus approach. Everyone on this team is also a journalist, although some people spend more time visiting different countries. For example, India could be an area where some of our team members will spend 70% of their time looking into. But obviously, they would also look into other markets as generalists, other sectors also, and this gives them an unbiased view, so they can bring more ideas to the table. Ultimately, what's important is that an analyst covering India stock or Chinese stocks should be able to know how that bank compares to a Singapore bank, a Thai bank, a Japanese bank, so on and so forth. It gives them a better perspective of what could possibly go right or what may go wrong with the company. So that is the kind of idea generation that we want to have and the kind of broad discussions that we want to have within our investment teams. We would say that one of our competitive advantage against most of our peers is that our investment team members have a significant portion of their own remuneration invested into our own team funds. So we invest our clients' monies as if it were their own, and this co-investment kind of reinforces the belief. Not only do they want to be aligned with the clients in terms of the identification of the best kind of quality companies to invest into, we also as a team, they cannot think of any other better long-term investments for their own retirement monies. And we believe that this is one of the best ways that we can achieve superior investment returns for our clients. So what is our investment process like? So I will refer to this slide to really distill that down, although I have the next couple of slides, but I think just to keep it down to be simple, what we want to do is to focus on generating absolute returns for our clients. Capital preservation is key for us. It's first and foremost at the back of everything that we do. We want to ensure that our clients and ourselves, we can sleep soundly in the night. With every decision that we make for investments, we want to consider the potential downside and not just the upside. To us, the benchmark is irrelevant in the entire investment process, as many of the companies that are on the benchmark is in fact not investable for us. Some of them are not even quality for us to invest into. So we don't get carried away by market noise. We are bottom up as investors, like I mentioned, and we truly mean that because we don't come up to forecast where markets are going to move to. Hence, we don't get carried away by market noise. Truly, what we are aiming to do is to identify highly competent managers, those that can actually grow earnings in a sustainable and predictable manner, invest into these names at sensible prices. Every year, we meet up with over 1,500 companies to assess their capabilities and their strength. We invest these companies with a long-term viewpoint of around 3 to 5 years. Most of these names that we have invested have been held for decades, so it's not a huge turnover for our portfolios. It tends to be quite low as well, and really that gives us the conviction that we are truly invested in the highest quality names holding, and we look to continuously add and trim according to our views as we go along. So I think in our view, in terms of portfolio construction, we think that the portfolio of stocks allows us to be well balanced for us to navigate the current market environment. And if you actually think of portfolio construction, we like to liken it like us having a garden. You don't want all flowers blooming at the same time. You want different flowers blooming during times of challenging period like winter. You want to have your hardy perennials like your TSMC adding color to the garden. So this is what we consider true, and we'll show you later on how we look at the resilience of the portfolio in times of market distress. At this point of time, I think we have a lot of discussions around ESG. There is a popular trend amongst investors today. A lot of people incorporate ESG into their investment process, but to us, as an investment team, we've been incorporating ESG within our investment process since the inception of this team back in 1988. So we've always recognized as a start that investment activities can have a material impact on the social and the environmental aspects. It's not just focusing on the pure corporate governance Obviously, this is one where the foundations of a lot of big companies are built. As a team, we don't employ checkbox ticking exercise. It's quite a complex subject for us to navigate. There's no single approach, no single path to prescribe to investors or companies. Rather, to us, it's truly the direction of travel that is more important. So the reality with ESG in China is that it's still very much starting off a low base. If you're going to compare this to ESG in some of these sophisticated American companies, you will find that it's really quite primitive in that sense. There are companies in China that are showing real progress, but they don't have the Microsoft equivalent that we're familiar with, that, they think about carbon footprint, they build wind plants, they also have your solar panels, etc., etc. All these things in China is happening at baby steps. A lot of the discussions that we have is focused on the direction of travel and on marginal changes that would happen to ensure that the portfolio is moving in the right direction. Now, so let's talk about China and what we view of it. So there has been a series of policy announcements that comes in from China, and that has sent market on a very sharp. Investor sentiment also turned negative in a very quick manner. And so what is China to us right now? If you look at this slide here, we have summarized some of the regulatory changes. So does this make China still investable to us in our minds? At this point, we believe that there are a couple of areas that we wanted to emphasize. And one is that the Chinese government is becoming more socialist and interventionist. It's promoting fairness and social equality for the people. In the past, the Chinese government pursued efficiency. So you've seen a lot of big platforms emerging from China. But now with the Chinese government, what they want to do is to enforce more control. They also want to relieve the burdens of the people over there, and hence they've intervened in the market. So it's not so much about the gains in the stock markets or the growth in large companies. At the heart of it all is whether the consumer rights and the employees' rights are subjugated by corporate profits. So this explains the rationale for Chinese government reining in some of these big companies in China. So just to quickly run through some of these regulations, the antitrust is where the big internet platforms have been targeted to ensure that competition can be fairer in the market space. It basically limits malpractices and monopolistic behaviors over there, like asking merchants to choose between one or the two of the platforms to assume exclusivity. They also cannot use big data to discriminate around users. And in the past, a lot of these large internet companies had actually used a lot of cash burning to help them to grow and to monopolize the market, and this has stopped. It has helped the internet platforms perform a lot better, and we expect it to perform better in the future. The fintech regulation protects the financial system, and if you look at the background around the pull-out of Ant IPO, it's because really the financial sector is heavily regulated in China market. Ant uses an asset-light business model, and that worries regulators quite a fair bit. And now businesses will actually need to have more capital to provide lending, and hence some of these businesses will have to change. The most talked about one in recent times is on the education policy on the education sector. So after school tutoring has actually developed quite well over the last 10 to 20 years. But the Chinese government, of course, wants to relieve the burdens that a lot of students and some of the families are also facing. And hence, they have implemented this series of rules to stop capital from pouring into the education sector. And they want to provide fair compulsory education for the kids. With the last two on Social Security, some of these platforms hire people who work for them on a contract basis, but they are not official employees of the company. They have got into Social Security troubles, and government's actually urging the platforms to pay for that. In terms of data security, also the data platforms probably know us better than we know ourselves. The way that we spend so much time on our mobile phones, what we are searching on, what we are buying, they know how to filter it out and to use the data to better their platform, and that intervenes with our personal lives. And obviously, that's what Chinese government does not want to do. They don't want these companies and big platforms to abuse the data to harm the consumers. So in summary, with all that was being discussed, we actually believe that tightening regulations is actually good for the industry and for consumers alike in the long run. We feel that the rules are a lot stricter today, and China's probably ahead of many of these other countries in putting forth these rules. Overall, they want to have platforms competing fairly, operating in a fair manner as well. Over time, for us, we would expect better collaboration between online and offline companies. But we are of this opinion that these headwinds don't dent China's long-term growth trajectory. There's still a lot of opportunities in China, and the next few slides that I will highlight on touches a little bit of the structural growth trends that we are seeing, like your increasing urbanization, consumption upgrading, your tech innovation, and some of the other factors that will further fuel China's growth in the longer term. So this slide highlights that China still remains an attractive manufacturing base. In the past, when we talk about China, or when we look at our t-shirts or shoes that we buy, always when we look at the label, we always say, hey, everything is made in China, right? What's new at that point of time? And if you take a look at what we used to associate China with, the recent one that we did was we associated China with your iPhones. And I think what I wanted to highlight here is that China has definitely moved up the value chain. It's no longer the same cheap labor that we are talking about. One of the most important recent events that we can emphasize is the completion of Tesla's largest manufacturing site in Shanghai. This is a project which took them just about a year to complete. And why we are emphasizing that is because it's not Tesla. It's not because it's Tesla, neither do we invest in these kind of electric vehicles. But people did not expect China to be able to manufacture cars that can be exported to the European market. Neither did they expect that a Tesla factory can be built from scratch within just 1 year. In terms of consumption trend, the Chinese government plans to reduce the country's dependence on the global economy. And this is something that the Chinese government has articulated within their 14th five-year plan. They want to achieve self-sufficiency. They want to boost domestic demand and consumption. And there has been subsidies that have been introduced over there to boost the purchase of car, home appliances, so on and so forth. As the Chinese economy develops and as income rises, people start to think about how they can improve their quality of life. And hence, in sectors like your consumer spending, education, and tourism, there's clear potential for growth even before the pandemic started. And we actually think that this is a trend that will continue for a very long time to come. So if you think about average selling price, not just with items that we are talking about, not just with tech items. Also, if you look at beers, for example, China's home to some of the cheapest beers that we can find in the world. 1 to 2 RMB, you could always find a cheap beer around. But today, there are craft beers that are selling for 10, 20 RMB. And this really shows you that the demand and the appetite change has also happened. And another trend that we are seeing is the popularity of domestic brands. Younger generations see their living standards rise. And as that happens, they become more confident about their local brands. Some of these brands, like your domestic sports name, like Li Ning, which we would have been familiar with, or even Perfect Diary, which is a cosmetic brand in China, it has also been doing quite well. And we believe that there are trends that will continue to persist in the future. In terms of innovation, this is about WeChat, right? So it's just an illustration of their mini programs. Similar to the experience that we find in Japan, best companies in China have managed to innovate and find markets for growth. So this on WeChat really just shows you, how these companies have moved up the value chain. They spend so much money on R&D, and they've been able to continue to innovate and come up with a very attractive platform. So, but it's not necessarily about tech or internet companies, which is why I wanted to highlight the reason behind the discussion on innovation. Companies that employ innovative decision making, for example, your drug making companies like Hengrui, or companies which leverage on technology to improve their business. For example, KFC under Yum China, which they operate under in China markets. You think about bank, property companies, like for example, China Merchants Bank. They also use very good technologies to help their business to become stronger in terms of the private and the consumer banking franchise. So we think that innovative businesses is not just about tech companies. There's a lot more to it. And within the portfolio, we are rather light on your e-commerce names. We tend to invest more in the hardware companies, names like your TSMC, so on and so forth, which will benefit our clients. On the Sino-US relationship, how does this impact our portfolio or even the Chinese economy? So if you look at the right-hand chart here, it shows us that China's GDP has risen to a point where they are able to challenge that of the US. It's currently about 70% of the US GDP, where Japan once was around the mid-90s. So China doesn't want to be they don't want to be overtaken. That is why they've imposed sanctions on some of these companies in China, like Huawei. So Huawei has a 5G market share more than 50%. But we wanted to highlight that there are historical precedents for the current climate that we are in. Back in the 1980s to the 1990s, there were numerous trade disputes that went on between Japan and the US. So at that point of time, the US levied very high tariffs on Japanese car imports, and that heavily impacted the Japanese automotive industry. And Toyota is a case in point, right? They are a company that has shown that they've been able to overcome obstacles to remain one of the world's largest car manufacturers. They use local resources in the US to actually help them to support their global expansion program and to maintain their status as an industry leader. So we wanted to emphasize that while these are measures that will continue to come in the future, quality Chinese companies, in our opinion, will be able to overcome and emerge even stronger despite some of these prospects. There's also been sanctions that the US have made. They blacklisted a number of Chinese companies as well. We've been relatively less affected. We find that the long-term value of a Chinese company is not whether they are US investors or not. It's one which we are invested into, which are mostly focused on the domestic consumption story and the domestic market. When sanctions are imposed, in fact, that brings a lot of nervousness to a lot of investors. Share price will drop according to market sentiments, but this, as contrarian investors, we believe that it actually represented a good time for us to invest in some of the companies to increase our holdings in the China weightage. So how is our portfolio being positioned? If you take a look over here, we have 5 broad themes. One of the litmus tests that this investment team thinks about on a regular basis, or every time we have our meetings, is we will think about what happens if the market drops by 20-30%. Am I going to sell off, or do I buy more of the names that I hold? If at that point of time I panic and I sell, then it really shows you never had very huge conviction in the portfolio in the first place. You shouldn't be holding on to it. Our portfolio turnover, like I did share, which includes trims and additions, tends to be quite low, lower end of the spectrum, and identifying that, these are quality companies that we want to hold for the longer term, and we would actually believe that they will be able to continue to grow over the long term. As a team, we focus on quality companies with proven management and track record. Some of these are your names like your dominant consumer franchises like China Mengniu, your Shanghai International Airports Media Group, that benefits from the structural trend of rising premiumization across the products as disposable income rises. We've also been beneficiaries, or you can invest in some of these healthcare beneficiaries that would benefit from aging population in the region. And on the third point here, we have digitalization beneficiaries. These are, I just highlighted earlier on, we are quite light on e-commerce names. On the back of the recent sell-off, what we actually did was we added to some of the e-commerce names like Tencent and JD.com. These are 2 platforms which have been relatively compliant with a lot of the regulators. They have a much lower risk compared to their peers. They are one of the more compliant companies that we'll be happy to add on more towards. They've also, in terms of the areas like your antitrust and all, we find that these guidelines will unlikely be an issue here because they actually leverage their platforms to build key traffic with key opinion leaders without them having to pay for clicks. So like I did share earlier on, we don't invest in sectors that causes harm to society. This will be into areas like your tobacco, gambling, weapons manufacturer. And I also thought I'll point out that we do invest in some of these globally competitive exporters. Many a times I get asked, is the team investing into electric vehicles, because this is a popular theme these days. Everyone is chasing after electric vehicles, given that China wants to move towards cleaner energy in the long term. Our exposure is quite limited. We are invested through second-tier beneficiaries. These would be beneficiaries like Mint Group, your Hongfa. Mint does your battery components. Hongfa does your electric vehicle high voltage relay. So moving on to the top 10 holdings, key holdings would be names like Media Group, China Manujiwi, China Merchant Banks, AIA Group. So some of these would be listed in Hong Kong, like AIA. They've been expanding their footprint in China market, and that should gain from rising penetration of insurance products, protection plans. So maybe I'll just tap on to one of the stock examples, which I think a lot of investors are familiar with. This is TSMC. This is a core holding, not just within our China portfolios. It's also a core holding within our Asia Pacific portfolio as well. We still believe this is one of the best ways that we can capture the rising trend of your artificial intelligence, your smart devices, Internet of Things. TSMC is one of it is the world's largest foundry. They've dedicated contract chips and manufacturers with more than 50% market share around the world. The growth has remained strong because of its advanced technology. They spend a lot on R&D, and their strategy is to be everybody's foundry. So instead of competing with the customers, they partner them instead of being competitors. So as the popularity within your semiconductor continues to grow, we believe that TSMC will be a big beneficiary of that as device becomes more complex and they require more and more powerful processors. Okay, so if you take a look at the country breakdown, I think this doesn't really mean very much to us, because at the end of the day, we are truly benchmark agnostic, and we don't really bother about how the benchmark's position versus ours, whether we are overweight or underweight. What we try to identify are the high quality companies that we believe will be able to ride through market volatility and to emerge as industry leaders in the long term. Okay, so if you take a look at the sector breakdown, this is also what we would invest into. In terms of share class, we have exposure to China, Hong Kong, and Taiwan, like I did mention earlier on. And in terms of investment style, I think at the end of the day, what you want to take back from this whole presentation is how the fund or our strategies tend to perform in a falling market environment. In a rising market, what I would share is that typically we'll capture most of the market gains. We might not necessarily outperform the market at that point, but most times we will do quite well. Up market environment, we will perform 50% over the benchmark. But in a down market environment where things get challenged, you want to have a lot more safety buffer within your portfolios. You want to have more resilience. This is where our portfolio can help because in a down market environment, we tend to outperform the benchmark 74% of the time. So in an all market environment, we tend to be able to perform quite well. So that leads to smoother volatility, a smoother journey for our clients with lower volatility. So that really shows you that the way that we think about the companies that we are invested into are really high quality enough, because in a down market environment, if you fall a lot lesser, it also means you take a lot lesser effort to gain back up to par. And that means protecting our clients' monies on the downside. So if you take a look at our fund performance, it has done well versus our benchmark against our peers over various time periods. And I would say we truly value it during times of market distress. Okay, so I'll hand the time back to Sarah. So Sarah, over back to you. Thank you so much for your time, everyone.
All right, thank you, Lisa. So once again, I just want to thank our speakers again, Zico, as well as Lisa from FSSA Investors. And have a great evening, rest of your evening, and stay safe. Yeah, thank you, everyone.
Thank you so much. Thanks, everyone. We hope to see all of you in person soon. Take care. Good night.